Civeo Corporation, ticker CVEO, beat consensus on revenue but missed on EPS for Q2 2026. Revenue came in at $180 million. That is an 11% year-over-year increase and beats consensus estimates of roughly $172.2 million.
Right, but GAAP EPS was a loss of 23 cents, which missed the consensus estimate of a 15-cent loss.
Yeah. Guidance for the full year 2026 was maintained, though, with revenue of $675 million to $700 million and adjusted EBITDA of $85 million to $90 million.
And the stock reaction was pretty telling. Shares slipped pre-market by over 1% on that EPS miss.
But they saw supportive regular session accumulation ultimately closing down just 1.75% at $30.96 as investors digested the cash flow and that top-line beat.
Okay, let's unpack this. Because if you're just glancing at those headline numbers on your phone, you're looking at a classic corporate optical illusion.
Yeah, it really is.
You have this robust double-digit top-line revenue beat, which looks great, but it is completely masking compressed operational margins underneath. So we're looking at a quarter where the surface looks like a victory lap, but the engine room tells a much more complicated, slightly concerning story. It's the defining tension of a company navigating this very specific sort of awkward transitional phase in the broader natural resource cycle. When you synthesize the broad strokes of this earnings print, you actually see Civeo demonstrating genuinely healthy organic growth.
Right, they're expanding their footprint.
Exactly, via integrated services. And they're getting a nice unearned tailwind from foreign exchange rates, specifically the strength of the Aussie dollar. But simultaneously, they are battling acute, punishing near-term cost friction.
It's a collision.
Yeah, a long-term top-line expansion colliding head-on with the short-term reality of operating in a highly inflationary, unpredictable global environment.
And to really understand how a company beats revenue by almost $8 million but still whiffs on earnings, we have to look under the hood at the segment-level margin compression. That's where the actual narrative of this quarter lives. Let's start with their biggest market, Australia.
The top-line strength there is definitely undeniable.
Oh, for sure. If you look at the report, Australia generated $125.4 million in revenue, up 11% year over year. A good chunk of that was aided by the stronger Australian dollar relative to the US dollar, plus some solid contributions from acquired villages. And looking at the underlying metrics, their average daily rate, or ADR, rose from 76.6 a year ago up to $85.
Which, on paper, a $9 jump in ADR is substantial.
Right.
In the hospitality or accommodation sector, a rising ADR is usually the holy grail because that price increase is supposed to flow straight down to the bottom line.
But it didn't flow to the bottom line at all. And this is where I have to call a timeout on management's narrative. They're insisting this margin pressure is transitory.
Right, that transitory argument.
But if you actually look at the Australian segment, the owned village room billings slipped. They dropped to 675,000 days, down from 691,000 in the same quarter last year. And more importantly, Australian adjusted EBITDA essentially flatlined at $22.6 million.
Yeah, zero EBITDA growth on an 11% revenue surge.
Exactly. How are you asking investors to accept that? Why should anyone holding this stock buy the excuse that this is just a temporary blip?
Well, what's fascinating here is the specific mechanics of the macro headwinds they're facing, which, to be fair to management, are almost entirely outside of their control.
Like what specifically?
First, you have to look at the ongoing seaborne trade dislocations in the Middle East. Civeo isn't running boutique hotels in downtown Sydney. They are operating remote mining camps deep in the Australian outback.
Like the Bowen Basin.
Right. To run a small town in the middle of nowhere, you need staggering amounts of diesel fuel to power the generators, transport the food, move the workforce. Geopolitical friction in the Middle East translates directly into spiked fuel costs at these remote sites, and that variable expense is violently eating into their operating margins.
So they are charging more per room, but the cost to keep the lights on and the AC running in that room has outpaced the price hike.
Exactly. And that's before we even factor in the human element. You have acute labor inflation in Australia right now. Think about what an integrated service contract actually means. Civeo isn't just handing over a room key.
It's full service.
Yeah, they provide the food, the housekeeping, facility maintenance, recreational facilities, finding, transporting, and retaining staff willing to do that intensive labor in a remote mining camp is incredibly expensive in the current market. They're paying a massive premium just to keep these camps fully staffed.
Which paints a pretty grim picture for their operating leverage. But let's circle back to my initial skepticism. You just listed structural geopolitical issues and a tight labor market. Neither of those things fix themselves overnight. So how does management justify calling this a transitory squeeze?
To understand the transitory argument, you have to look past Civeo and look at the behavior of Civeo's customers. In the Bowen Basin, the primary driver for these camps is metallurgical coal.
Which is different from thermal coal, right?
Very different. Thermal coal is burned for electricity and faces massive regulatory headwinds. Metallurgical coal, or met coal, is an essential ingredient in this steelmaking process. Right now, met coal prices are sitting very healthy at $220 plus per ton.
Oh, wow.
Yeah, so at that price point, the underlying mine economics for Civeo's clients, these big global mining conglomerates, remain highly profitable.
I see. So the end product, pulling these workers into the outback, is still highly lucrative. The mining companies aren't packing up and going home.
They aren't going anywhere. But because of the immediate fuel cost spikes and the general macroeconomic uncertainty, those mining executives are playing defense.
They're acting conservatively.
Right. Instead of bringing in an extra 500 contractors for a massive expansion or a deferred maintenance project this quarter, they hold off. They limit the temporary headcount, which is exactly why you see Civeo's room billings drop from 691,000 down to 675,000.
It's just a delay.
Yes. The projects are not canceled. The maintenance on those massive mining rigs still has to happen, and the underlying economic incentive to extract that coal is fully intact. That is the core of the transitory argument.
Got it.
Once fuel supply chains normalize, or the mining company simply can't delay their maintenance any longer, that pent-up demand for accommodation will flow back in forcefully.
That adds a lot of context. It's not a destruction of demand, it's just a shift in the timeline. But if we pivot over to their North American operations and look at the Canadian segment breakdown, we see a completely different flavor of margin compression.
Yeah, the dynamics there are totally different.
Canada delivered $54.6 million in revenue, up 9% year over year. Their ADR ticked up from $94 to $96, and unlike Australia, their build rooms actually went up. They hit 458,000 days. Everything looks incredibly healthy on the top line.
It really does.
Yet Canadian adjusted EBITDA dropped to $6.0 million from $6.9 million a year ago.
And this drop has a much more localized operational explanation. That revenue bump in Canada was driven, in large part, by a brand new integrated services contract in Ontario.
Okay.
When Civeo takes on a massive new contract like this in a remote Canadian region, they aren't just unlocking the front doors of a pre-existing building. They have to mobilize.
Right, and mobilization for remote infrastructure isn't cheap. Can you walk through what that actually looks like on the ground? Because I think investors often miss the sheer physical scale of what this company does.
Imagine having to build a fully functioning, self-sustaining neighborhood hundreds of miles away from the nearest major city. You're trucking oversized modular buildings across difficult terrain.
Wow, yeah.
You're setting up independent water filtration systems, massive power grids, commercial kitchens, medical facilities. You're flying in chefs, logistics managers, and maintenance crews. All of this happens before a single mining or infrastructure customer actually sleeps in a bed and generates $1 of daily billing revenue.
So they're absorbing a massive upfront cash burn just to get the site operational.
Exactly. Those startup costs for the Ontario contract were heavily recognized in the second quarter, which dragged down the Canadian EBITDA.
But again, these are one-time mobilization expenses.
Right. It's the cost of entry.
Yeah.
Once the camp is fully built, stabilized, and the daily billing normalizes, those margins historically expand right back to their standard run rate. It's a calculated trade-off.
You endure short-term pain on the income statement to secure long-term contracted cash flow.
Precise.
So if you're bleeding cash on diesel fuel in Australia and you're fronting millions of dollars to drag modular homes across the Canadian wilderness, how are you paying for all this without wrecking your balance sheet?
Well, that brings us to their capital allocation.
Because to me, the most aggressive moves Civeo made this quarter weren't in the dirt, they were in the boardroom. Here's where it gets really interesting.
Oh, definitely. The financial maneuvering this quarter signals a tremendous amount of internal confidence from the management team regarding their underlying valuation.
Yeah. Civeo just completed its 20% share repurchase program. They aggressively retired over 660,000 shares for roughly $22.3 million. And they didn't take a breather. They immediately authorized a brand new 10% buyback program.
Which is an aggressive return strategy.
Extremely. But to fund this, while still managing those heavy mobilization costs, they executed a major structural capital shift in July, just after the quarter closed. They issued $115 million in 4.5% convertible senior notes due in 2031, and they set the conversion price at $40.51.
And for context, if you're looking at the ticker today, the stock is trading right around $31.
Right. I like to think of this maneuver like refinancing your mortgage. You do it to lock in a lower rate and maybe pull out some equity to build a massive home addition. That's exactly what Civeo is doing here.
The mechanics of this specific debt issuance are really a masterclass in corporate financial engineering.
They're locking in a much lower fixed rate cost of capital at 4.5% for the next 5 years, and they're taking the proceeds from those notes to immediately pay down their floating rate revolver.
Which is critical in this macroeconomic environment. For those unfamiliar, a floating rate revolver is essentially a giant corporate credit card.
Right.
The interest rate on that debt fluctuates, usually tied to benchmark rates set by central banks. Over the last couple of years, as interest rates have spiked, maintaining a high balance on a floating rate revolver has become incredibly expensive.
So they're stopping the bleed there.
Exactly. By paying down that revolver with the proceeds from the convertible notes, Civeo has essentially cleared their primary credit line. Their net leverage ratio is now sitting at a very manageable 2.1x, based on about $191 million in net debt.
But the word convertible usually sends a shiver down the spine of retail investors because it implies future dilution. If the stock hits that $40.51 strike price, don't the debt holders just convert those notes into millions of new shares, watering down the value for everybody else?
That is the standard fear, yeah. But management structured this specific note to protect current shareholders.
Yeah.
They structured it so that they will settle the principal amount of the debt in cash.
Meaning, if the stock hits $40.51, they aren't flooding the market with $115 million worth of new equity.
Exactly the opposite. Only the premium, the value generated above that strike price, would be converted into equity. The initial $115 million principal is paid back in cash.
That's a smart structure.
It deliberately limits shareholder dilution while maximizing their immediate flexible liquidity. Prior to this convertible note, their total liquidity was sitting at $82 million. By clearing the revolver and shifting to fixed-rate debt, they now have massive dry powder to deploy.
Which begs the obvious question, what is this dry powder for? You don't clear the decks on your corporate credit facility and restructure your debt profile for 5 years unless you're anticipating some heavy lifting.
No, you certainly do not.
And that brings us to their bid pipeline. Management is currently tracking a $1.5 billion bid pipeline across North American infrastructure. And this isn't just traditional mining in the oil sands.
Right. This pipeline includes liquefied natural gas or LNG facilities, massive power generation infrastructure, and significantly data centers.
Data centers are huge right now.
Huge. And if we connect this to the bigger picture, management's deliberate pacing and their obsession with balance sheet flexibility makes perfect sense. They're looking at a fundamentally shifting infrastructure landscape.
Okay.
They aren't rushing out to build brand new assets and taking on speculative debt in a high-rate environment. Instead, they are quietly preparing their existing idle fleet.
Right. They have a lot of assets already.
They do. They currently have 2,700 mobile camp rooms sitting in Western Canada. Yeah. They have another 7,000 to 8,000 oil sands lodge rooms ready for redeployment. They are holding these physical assets, keeping their balance sheet pristine, and waiting for their customers to make final investment decisions.
Those FIDs.
Yes, FIDs on these massive, multi-year infrastructure projects.
For anyone tracking the timeline on those FIDs, when do these massive projects actually break ground? Like, when does that $1.5 billion pipeline start showing up as actual cash flow on Civeo's income statement?
Management is explicitly targeting late 2026 for those final investment decisions to be finalized, which means the real meaningful cash flow from that pipeline won't hit the earnings reports until 2027.
So it requires patience.
It does. You are asking investors to hold the stock through these near-term mobilization costs and Australian fuel headwinds for a payoff that is over a year away. But the setup is highly asymmetrical because the assets are already built.
But investors don't have to wait entirely until 2027 to see a bump in revenue. Management pointed out a very specific, much closer catalyst for the second half of this year.
Right, the Canadian operations.
Yeah, they expect their Canadian operations to deliver 20% year-over-year revenue growth in the back half of 2026.
And that 20% spike is a direct result of seasonal timing and delayed customer behavior. In the Canadian oil sands, facilities require major maintenance turnarounds. This is where they bring in thousands of temporary specialized workers to service the refineries and pipelines. And some of those were delayed, right? Exactly. Several of these massive turnarounds were deferred from the second quarter into the third quarter.
It's like a ski resort delaying its opening weekend because of an unusually warm November. The snow is still coming, the skiers still bought their passes, and the revenue isn't lost, it just shifts into the next month's accounting ledger.
That is a perfect way to look at it. That deferred maintenance revenue is locked in. That expected 20% growth in Canada will provide a very solid, immediate bridge of cash flow, while the company waits for those larger 2027 infrastructure FIDs to materialize.
And if you look at how the sell-side analysts are digesting all this information, it perfectly validates why we saw regular session accumulation of the stock after that initial pre-market dip. Wall Street isn't panicking over the EPS miss.
Not at all.
Stonegate Capital Partners just updated their coverage, blending a discounted cash flow model with an EV to EBITDA model, and arrived at a midpoint price target of $36.77. Meanwhile, Stifel maintained their buy rating and firmly held their $37 price target. When you consider the stock is trading near $31 today, the smart money is clearly pricing in that 2027 pipeline.
It shows that analysts are willing to look past the muddy surface of this quarter. They are ignoring the one-time startup costs in Ontario and the geopolitical fuel inflation in Australia.
Right.
Instead, they are valuing the structural capacity of the balance sheet and the massive embedded optionality of those 10,000 plus available rooms waiting in Canada.
So what does this all mean? When you strip away the quarter-to-quarter noise and the headline miss on earnings, Civeo is essentially taking calculated short-term margin hits to position an absolutely pristine balance sheet for a 2027 infrastructure boom.
Exactly.
They're buying back their own stock at a perceived discount, they're locking in cheap fixed-rate debt, and they're lining up the dominoes for a massive, highly profitable deployment of their existing assets.
This raises an important question, Workforce accommodation companies like Civeo operate deep in the background of the global economy, but they act as the ultimate canary in the coal mine for macro capital expenditure.
Because they're the first movers?
Right. They are the companies who have to build the beds and cafeterias before the structural engineers and data center technicians even arrive on the job site. If Civeo is quietly hoarding cash, clearing out its revolving credit lines, and prepping thousands of mobile assets right now, what does that signal to you about the sheer volume of heavy infrastructure, power generation, and AI data center builds coming down the pike over the next 24 months?
It's a massive tell for the broader economy, hiding right there in the mid-cap industrial sector. The physical infrastructure boom has to start with housing the workers who build it. That is all the time we have for today's deep dive into Civeo's quarter. Make sure to follow the show for daily, no-fluff earnings coverage and stock analysis. We'll see you next time.